Welcome back to the Infinity One podcast, where we sit down with the boldest voices in real estate venture and innovation. Today, I'm joined by someone who truly lives at the intersection of capital markets alongside education, Huber Bongolan, who has over 15 years of experience in commercial real estate and residential real estate finance. He is the founder of Credible CRE, which is a thought leadership platform followed by over 12,000 professionals. He sourced over $3.5 billion in capital transactions, and he currently serves as the head of capital markets at StackSource and SVP at Flipside Lending, connecting developers with creative and customized debt and equity solutions all nationwide. He holds dual master's degrees, MBA and MRED from USC, and he is also an Eagle Scout, licensed real estate broker, and a leader in both ULI and FIRE as well. Hubert, thank you so much for coming on the podcast.
Hey, Zeus, appreciate the time. It's humbling to hear that said back to me. I'm like, whoa, I did all that? But it's been a great learning journey for me. And part of Credible Series, as you mentioned, is that educational aspect. So I love sharing what I've learned, right? We met through UCLA and me doing some seminars and guest speaking engagements there. So I'm always happy, and my passion in life is to be able to share what I've been lucky enough and fortunate enough to learn over my career.
That's amazing. That's something that we both have in common. I really love giving back to my community and teaching other people anything that I learned. So that's awesome, Hubert. And I want to start off by asking you this. For those of you who may not know you, how did you get started in real estate in the first place?
So I have a kind of an interesting, unique journey where I started on the residential side, the 1 to 4 unit space. And then I transitioned to the commercial side for another decade. And now I kind of play both on both sandboxes, let's say, where I finance deals both on the commercial side as well as on the residential 1 to 4 side. So to answer your question directly, I started off as a loan officer for conventional 30-year fix and flip, not even fix and flip, just 30-year loans. Um, my goal when I came out of undergrad was, hey, I heard about this thing called passive income. People were using real estate to do it. How do I buy my first home? And this was after the great financial crisis. So there was no more stated income, stated assets, no more of these Nina loans, right? It was actually full doc, very tough to get at this time in the world. So for me, that learning opportunity, I wanted to go to a firm that could teach me everything it took to buy a home. That was the start. With simple curiosity of, I heard this term called passive income. How do you people do it? Oh, real estate is one of those channels. It's something that I can feel, touch. I lived in a home. I know what a home is. So let me try to find a way to buy one for myself as an investment property and start going down that path. So it was just that seed of curiosity of how do I do something? And that's what got me going.
Yeah, that's amazing. And I know there's a lot of people on this podcast who are just getting started in real estate. So, since you have experience on both the residential side and the commercial side, can you break down just the fundamentals and the differences between the two asset classes?
Yeah, I'll try to keep it as simple as possible. And then a short plug, I'm coming out with a book later on this year in August that will go over this in much more detail, right? So happy to share that later on with you, Zeus. But at a very high level, the residential side is simply anything that is a 1 to 4 unit dwelling property, 1 to 4 dwelling units. So people, they can think kitchens, bathrooms, a single family home, a duplex, triplex, fourplex, right? That is what I call the residential side. On the commercial side, it's hotels, it's office properties, it's retail shopping centers, industrial warehouses. And it does have a residential component, but it's specifically called multifamily, and it's for properties that are 5 units and above. So anything 5 units and above, multifamily, apartments, that's in the commercial bucket. And then the other bucket is residential. So at a very high level, those are the two. They're very different in terms of the way that they review deals, very different in terms of the jargon, the lingo, the metrics that are considered, right? Almost two different worlds, but they're under the same kind of playground that we just call real estate. So if anyone thinks, oh, real estate, I know real estate, I've heard of it before. Really, even under the umbrella of real estate, it immediately branches off into, well, are you in the 1 to 4 unit residential side? Or are you in the commercial side, which again includes that 5 units and above multifamily?
That's amazing. That's so, so cool. And Hubert, what led you to starting Credible CRE? because I know
Yeah.
it's a really big thought leadership platform, and I personally have taken note of it, and it's something really, really inspiring.
Thanks, man. Yeah, I mean, in another life, I love teaching, right? So for me, it's that's in all of my careers, I've always gravitated towards like, hey, when someone new comes on, who's going to train that person? Who's, because I love it's just a passion of mine, sharing what I've learned, right? Regardless of if I'm getting paid for it or if I'm just doing it as that. So Credible CRE was my way of saying, hey, I'm fortunate enough over the course of my career to now have access to a lot of different sources in different areas when it comes to commercial real estate. I find certain things interesting, and luckily my subscriber base finds it interesting also. How can I take things that might seem complex on the surface but break it down to where it's easily digestible? Someone with a very elementary or starting out in commercial real estate can understand it, right? How do I break this down and supply it in a format that's easy for people to understand, right? So that was the impetus of Credible CRE. Is I'm fortunate enough to have access to all of this information and data, right? The information comes in from a lot of different places and is usually packaged up to where it seems very complex. How can I synthesize it, put it all together, and make it very easy for others to understand? And it's just been growing from there. It started off as just, hey, I'm just going to share it with my buddies, right? I'm going to share it with my friends. And then over time, it's just grown and snowballed to where it's, oh, I'm going to share it with this person, share it with that. Who wants to join, right? So that newsletter comes out every Mondays and Thursdays, where it's just what are we seeing in the capital markets, breaking it all down, right? And then if people wanted more time for specific deal help, right, specific business plan review, that we do one off in a more consulting capacity.
That's awesome. I personally have read it, and it's very digestible. So I suggest all my listeners to take a look for sure.
Yeah, thanks. And
And
they could easily just go to the website, right? And if right there at the top of my website, crediblecre.com, you can just put in your first name and email and follow along the journey.
that's awesome. Hubert, I want to ask you a bit more of a more on the technical side now. And so as an emerging GP and emerging developers who are starting out in the game, what do you see like is the biggest mistake that they make when trying to raise both debt and equity?
Yeah. So number one is he said emerging GP. So for the audience here, he's talking about emerging general partner, the person that's really going to be the workhorse of the deal, the person that's putting it all together. They're finding the opportunity, they're sourcing the capital, they're getting their GC and their designers and architects. They're the one that's on the day to day doing everything for the deal. So his question really is, what do I see as common mistakes for people that are starting out trying to do it all and run their own deals? And really, the common mistake is trying to do it all, right? Not having a proper team around them, not like maybe hiring someone just because it was a friend of a friend, right? Not necessarily the professional. So number one, and I'll break down kind of three things that I see commonly with general partners is they have the wrong team around them, right? Someone on the team needs to have the experience, right? We talked about an emerging GP, so maybe they don't have that track record yet. You got to bring some like real estate, and especially real estate development, is a very long, it's there's a lot of potholes, a lot of roadblocks, things that with experience you kind of understand and know. So I would say number one is forming a team around you that are experts, professionals in their own realm, but also have that experience to be able to foreshadow and see and navigate through issues that come up, because issues will undoubtedly come up, right? So that's number one. I'd say number two is somewhat being disorganized. So you want to have all your ducks in a row. You want to have a nice Dropbox or things put together like in a nice P&L, a nice balance sheet. It shows that you're a professional, that you know what you're doing, right? When I say by disorganized, it's when from the capital side, when the lender or the investor, when they're getting things piecemeal, right? They're getting text messages, they're getting. It's fine to have all that, but when you're asking for money, the person that's giving the money doesn't owe it to you. And I think that kind of gets lost where it's like, oh, there's lenders all over the place. It's like you still have to put on a good show is not the right word, but you have to put the semblance on that you're a professional, you're well organized, you know you're doing, because if we're going to entrust our capital and you're asking either an investor or a lender to entrust their capital to you, right? You want to give them the confidence that their capital is in good hands. So I would say that's number two. And then I would say number three is not testing really their assumptions, right? I think in that realm or in that understanding of they're trying to do everything, right? A lot of times, a lot of assumptions need to be made as you go through. What's my rent growth going to be? What am I going to be able to sell it for? What am I, my timing? Can I get this done in 3 months or 6 months? Will permits come in on time? There's going to be a lot of assumptions you have to make as a developer. And what I find a lot with emerging professionals is they're they have these rose-colored glasses on where things are going to work out to perfection, right? I'm not going to have cost overruns, so why do I need a contingency reserve? I'm not going to be delayed on my deal. I'm going to be able to do it in exactly 10 months or 12 months, right? So I think that not having the proper contingencies, not having the proper sensitivity analyses for what if you don't hit your baseline, right? What does the deal look like in a downside case scenario? I tend to see a lot of emerging GPs not really think about that, and they're more thinking of what's the best case scenario and how much money am I going to make.
That's a great answer. And you mentioned, Hubert, that for the first mistake that they make was not having the right partners and the right team
Team.
around them. So
That's right.
you yourself, you have accumulated over like 5,500 capital providers, and I know you have a wide range of a network. So how does one emerging developer or person in real estate go about finding the right partners to execute their business plan?
Yeah, truthfully, this is still a very much relationship oriented game, right? Relationships absolutely count here, a lot of trust. So I would say the first step to go about finding the right teammates is referrals from people that you trust, right? So I had mentioned before, like friend of a friend, like maybe that's a bad idea. It's a bad idea if the friend of a friend is like not a professional. If the person that's being referred to you is a professional and you can like, they pass, you can look them up. They've been in the game many, many years. They have a long track record. They've worked with other people and had good outcomes. You vetted them and talked to other partners they've had, and it's been successful, right? Um, I would say that that is really important in how do you build that team? A lot of times it's through trusted referrals, right? That's usually the way. Or starting small, right? If it's a new relationship, maybe it's someone that you met, you found their information online, or it's someone that was a loose relationship referral that you just kind of, or you stumbled upon when you met them at a networking conference. Start small. I wouldn't say start a huge, big endeavor with that individual per se. It's like maybe do a couple of things together. Start with a smaller deal and then work your way up, or start on a deal where it's a limited capacity. And if that goes well, then kind of work your way up from there. So I would say that try to de-risk the situation as much as possible by either A, working with very trusted professionals that come highly regarded from multiple sources, or B, starting small with that person with smaller deals, not as complex deals, low dollar, low risk deals, and then working your way up and growing the relationship organically from there.
That's amazing. And I can't speak to that. I know for sure that real estate, it's all relationship based, and it's great. That's why I'm in this business, because I myself love working with other people. So that's awesome. And Huber, another question for when like regarding emerging GPs, like how do they go about structuring the capital stack for their first deal? Because I know a lot of them would rather just get the credibility and take, a lower return on their project. So how do you see them like do that when they're first starting off?
Yeah, there's a lot of ways, and I'll kind of go through the game. For an early professional, you're probably not going to be able to get into the institutional bucket. So let's just take that one out because that is a way of getting money, but usually that's meant for institutional long track records. You're more mature in the game. So let's talk about emerging professionals. Typically, the way that you see it is done two ways. Either A, somehow, fortunately, through the course of their career, they've been able to put together a big lump sum of money, and either them and their partners are well heeled, well capitalized by themselves, and they can put money into the deal as the entire equity portion that's needed. That's one way. Although you don't see it that often because not these are big deals we're talking about. Not everyone is that fortunate. The second way that you typically see it done is I like to call it passing around the hat, where you have a great deal, you package it, you create the investment summary, you talk about all the highlights, your business plan, here are all the key metrics, this is exactly what we're going to do. And you have probably 20 to 100 people in your Rolodex that you trust and they trust you, right? And they want to come in what's called an LP position, a limited partner position. So you'd be the GP, you're the one that's doing everything. Let's say that you need, let's just call it $1 million for nice round numbers. let's say you and your partner are able to put together 100,000 for this deal, right? Which is very typical. So you and your partners, who are the GPs, would put in 10%, and then you would email all of your Rolodex. You would have a nice little Zoom meeting to discuss the deal with them, and then you would say, "Hey, who wants in on this deal?" Right? Assuming that they're accredited investors, you've done all of the correct, the right ways to raise the money. You've gone through those background checks to make sure you're not accepting money from someone you don't know or don't trust or has a bad background. And then usually they would be the ones that through your network, you raise the other 90%, so that other 900,000. And they're limited, they'd be LPs, so they don't have decision rights. You're the ones making all the decisions, but you're promising them some type of return that they're going to get for them putting their cash and investing it with you. Those are typically the main two ways. I mean, there's a third way of just like a rich uncle or a rich family relative, right? Where maybe you have someone in your network, a family friend that is showing you're emerging. So maybe you got inspired by seeing a family member do it, and whether it be your parents, whether it be uncle and aunties, whether it be whoever, but you see a family member that is very well heeled, that believes in you, will show you the way, right, and will finance your first deal, right? Where in that case you only have one limited partner. So I would say that probably should have been path two. So path one would be it's your own capital. Path two would be you raise it by a single or two or three just family members or really, really close friends. And then path three is where you go out to your Rolodex of 50 to 100 people that know you, trust you, and they're putting in smaller check sizes of 50 to $100,000 each, right? You find yourself 9 to 20 of those that trust you, will ride alongside you, invest in you, and then you're able to put together like a small little fund from there specifically for this deal. So those are the main three ways that emerging investors capitalize the equity portion of their first projects.
Sounds good. Sounds good. And Huber, I want to transition this conversation now more to the current state of the market. What do you see right now going on with commercial real estate financing and the issues that a lot of GPs are having when it comes to raising capital and raising debt and equity?
Yeah, I'll take you back in time, not too far back in time, but like 6 months ago to a year ago, where everyone was like, stay alive until 2025. 2025 is going to be our year. Or this is where it all comes back. That's what everyone was talking about last year. It's just, man, the market's tough right now. Man, inflation is rampant and interest rates are on the up, right? When is this going to stop? It was just stay alive until 2025. That was the mantra. Well, now we're here in 2025. And I will say Q1 was a very strong Q1, right? You had a lot more transaction activity to start the year in the beginning months of the year because there's all of that excitement that carried on from a very strong Q4 of 2024. But the name of the game right now is uncertainty. So without getting into the political realm, right, it's just what is clear is that investors are uncertain of the future. We don't know what's going to happen next. It seems as if almost every day there's something new that comes out where it's fear or something, right? So on one side, you have majority of players, maybe institutional players that, hey, with all of this fear, we're going to kind of pull back a little bit and wait until there's kind of clearer skies ahead before we start investing, wait until we have a little more confidence. You also have some contrarian players that are maybe this is the time, right? While they pull back, we come in. So that's why it's a market. That's exactly a market. You have people that they see a glass and it's half full. You see other people, they see it half empty, right? So on and so forth. But I'd say the majority of the market is kind of right now, it's uncertainty and trying to figure out, okay, if we are uncertain and we don't know what the next 6 months to a year to 2 years looks like, then maybe we kind of hold firm and focus on just optimizing what we currently have versus we're going to go out and buy more properties. We're going to go out and do riskier plays like ground up construction. So that's kind of the state of the market in one word. It would just be uncertainty.
Hubert, and how are you advising your clients amidst this uncertain market and this high interest rate market with like in terms of geopolitics and everything? Like, what are you telling them they should do and they should not do? And like what new opportunities, as you mentioned, the contrarian players, like I know a lot of them that are actually, putting their capital to use and a lot of them are more scared waiting on the sidelines. So what strategies are you
Yeah.
advising them to do?
I'll answer your question, but first I got to give a disclaimer, right? This is not investment advice. This is just me giving some type of educational, right? How to think about certain things. you should absolutely consult a trusted professional in your group before taking on anything. So, but with that said, I would say with uncertainty that we just talked about, right? Control what you can control. One of the things you can control are the terms of which you agree to certain things. So a popular play that I'm seeing right now is making sure to structure in no prepayment penalties in the financing part of it. So when you take on a loan, depending on the type of capital that you're getting, some lenders will charge a prepayment penalty. That means that if they give you a loan for 5 years, 10 years, if you pay it off early, there might be a penalty associated with that. One of the strategies that I'm looking for from my clients are no prepay options or flexible prepay options, and making sure you get that in writing. Because in the event that if rates go down in the next couple of years, you want to put yourself in a position where you can refinance to lower interest rates without there being a penalty for doing so. So I'd say that's a big strategy right now that we're looking for is no prepayment penalties.
Sounds good. And where do you see the biggest opportunities in commercial real estate within the next 2 or 3 years?
Smarter people than I are talking about office because of the fact that it's been such a depressed asset over the past 5 years. Like really since the onset of COVID, office has been really depressed. Like retail was pretty tough. Like in the 2010s, that was a tough period for retail. And now it seems like retail is back, right? It seems like retail is back. ICSC, everyone's very excited. Now it seems that office, not even seems that, it definitely has been over the past 4 years or so, office has been tough for most people. So when you say where's the biggest opportunity, right? I'm not saying go jump in and buy office right now because you don't know when it's going to get better. That's the whole purpose of a market, right? If everyone looked at stock charts, right? If you're looking at the past performance, like, oh yeah, I should have bought at that time. I should have known better. But in the moment, which you are right now, you don't know if it's going to get worse. You don't know if it's going to keep going down. But smarter people than me, and when I watch certain webinars and I kind of buying into it, it's like if you can find a great office play, right? If you have the ability to know which tenants are expanding and where, and you're able to sign leases, right? In those places, those could be great opportunities, and you're willing and you're patient, right? I wouldn't be going into this if you need to get out in 12 months or 2 years. This could take 3 to 10 years for it to turn around. So if you have patient capital behind you, it seems like there are a lot of opportunities right now in office versus assets like industrial or data centers that are priced to perfection because it's so popular, they're very expensive. So for these asset classes like industrial or data centers, your business plan basically has to go pretty well, or the hope that it's going to continue to become more expensive.
I actually heard the same thing. Earlier this year, I went over to a Real Deal event and they said how buying office right now with patient capital might be the move for the coming year or so.
I was not there, but I like that person.
And where do you see multifamily headed within the next like 2, 3 years?
I think that there are so multifamily is going to be a story of supply and demand. I think that you have you have three issues at play, and how you weight each of these issues is going to determine like how you think of multifamily. Because I don't like saying, and I had a professor that used to always preach this to us, that you can't, it's hard to just take one aspect and say the whole thing is going to be that way, because real estate is very locational based. So multifamily in Austin, Texas, having a tough time, right? Multifamily in Los Angeles, maybe doing a little bit better. I don't know. But what I will say is some of the issues to think about when you think about how multifamily is going to be doing specifically in your location is number one, supply and demand. So how many people, let's start with demand. How many people are actually coming to the area? Is population increasing or decreasing? Because that will have a direct effect on demand for multifamily units, right? Are jobs coming to the area? Are people coming? Demand. Supply. How many units have come on in the past year? So if you have a lot of units coming on or have came on in the past year or two, and then you have a population that's either stagnant or declining, it's probably not going to be a good sign for multifamily in your location. Vice versa, if you have supply that's constrained and not necessarily growing, but you have a population that's growing, right, in that area, then you're probably going to be pretty good on the multifamily side, right? So I'd say supply and demand is one of the key metrics to be looking for when you're assessing is multifamily a good deal or not. A second key metric would be the actual demographic of the area. So let's take population as a constant and just say it's fixed, right? Because you can't have too many moving levers in order to make this theoretical like estimation. When it comes to the demographic of the population, where are they in their kind of life cycle? Like a lot of the themes over the years have been like watch what the millennials are doing, right? And that's kind of where great plays come in. Well, a lot of millennials are entering they in the 2010s in the late 2000s, like 2008, 9, 10, and the 10s to 2019, 20. That's when millennials were in like their 20s, right? So when you're in your 20s, you want to be in urban areas. You want to be renting. You want to be moving around and have that freedom of I'm going to go to that job and go to that job and I'm going to go out at nighttime. Urban cores and multifamilies did fantastic during that time frame, and you had a lot of demand because that's where millennials were moving into. Well, a lot of millennials now are in their 30s, approaching 40s. You have a different stage of life, and typically those millennials are now going to the suburbs, maybe getting married, maybe starting families. Right? They have different interests, so you're starting to see that demographic shift. So that's a second question to ask yourself. In your location, what's the dominant theme? Are Gen Zs now coming and you have more 20-year-olds in the area? Or do you have more 30s and 40-year-olds in the area where now they may not want to be in the urban core anymore? That may not be a great place to start a family. So that's the second kind of thing that I would think about. So supply and demand being number one, and then your specific location, how are demographics kind of changing, right? Because you're kind of solving for what's going to be the next 3 to 5 years if I buy this asset. The last thing that I would look at is the rent to home ownership in your area. So specifically, a lot of like I'm in Orange County right now. A lot of areas here are very high priced. So maybe there's a lot of renters. I just saw an article on Red One. I forget who posted it, but that in certain metros and in certain suburbs, renters are now dominating over home ownership levels. So is the rental market when it comes to multifamily in those areas, are people actually is there more net buyers in that area? And maybe if you have a multifamily in your area, it's like those people are going to end up buying, so they wouldn't be your target client as a renter. Or are you in an area that blends itself to, oh no, more people are renting in this area versus owning, and that's what they do. So you have a longer runway of people, of potential tenants in your area. So those would be the three things when you're asking me like, hey, how about multifamily fundamentals? Those would be the three things that I look at, but specifically for the location in which, like, what is the specific area that you're trying to buy this multifamily property?
That's a great answer. I'm always saying that real estate itself, it's super hyper local and it's all data driven. So that makes perfect sense. And Hubert, like I myself, I'm very forward thinking and I like innovation a lot. So I want to ask you this. Where do you see AI coming into commercial real estate in the future?
Gotta learn it, guys. You must learn it and embrace it and figure out. So I would say an analogy would be imagine someone that never wanted to use the internet, right? And they were in the 90s and they were a great broker. I don't care if you're beginning in the game and I don't care if you're 50 years of experience in the game, right? Tech is coming. And imagine if someone was in the 90s and they decided, I'm never going to use the internet, and the old school ways might still work. Like if you have a great Rolodex of people that just call you and you're able to walk in, sure, great, that can. But if you don't embrace the technology, it doesn't mean that you're out of business. It just means that there will be someone that comes that can move faster than you. And if speed is important to what you do in your business, then embracing AI and having it be able to enhance and save you time, um, it's going to be it is already a game changer and will continue to be. So for anyone that's watching, what I will say is, if you plan on being in this industry long term, think of it as like the internet coming in the 90s when it didn't exist prior, right? And now we all use it. It's almost like it's a must. You just have to know it, right? How it's going to be. That's how it kind of is already. And it's going to be that way 3 years, 5 years, 10 years from now. If you're not embracing AI and trying to figure out a way for it to augment and make your life easier and help you move faster and help you do more, you'll slowly be left behind as if you were someone that did not embrace the internet and it's just still, you could still operate the old way. It's fine. You can, but you won't be able to move as fast. You won't be as someone that is embracing the technology.
Yeah, completely agreed. I always say that speed in business is what determines your level of success. So that's amazing. And here I want to ask you now a bit more personal questions. What has been your favorite deal or project that you've worked on over your career?
Yeah, one that comes to mind just because it was a very it was unique. So I see a lot of multifamily deals, right? I see a lot of office deals and retail deals, hotel deals. But the one that was unique was our California National Guard, just because it's in Sacramento, right? It's a government kind of lease there, which is different from a normal lease. So knowing the nuances of that and being able to learn it, the special privilege, like being able to walk through it, like I did not serve in the California National Guard, so to be able to go into there and then be financing the building in which they operate in, right? So that was pretty special for me because I'll never come. I don't think I'll ever come across another deal where I'm financing the National Guard of a state, of an entire state, their headquarters. So that was really cool for me to work on. And on top of that, it was a competitive, uh, let's say, competitive landscape. You have little old me versus like bigger shops like the JLLs and HFF at the time and different shops that were all competing for this deal. So I think for me, it was speed that we talked about, right? I was able to move faster just being here and then um, really tenacity on that deal, right? There's this very specific tenant, very specific lease structure, very specific requests from the client, right? So for me, those three things made it a very difficult, challenging deal, but a very memorable deal as well.
Sounds good. That seems like an amazing story. And Hubert, I know that you're involved in both ULI and FIRE. Can you talk about how you got involved in them and then why mentorship is so important to you?
Sure. So ULI is it's an incredible group for anyone that is starting out, anyone in any part of their career. But for me, it helped me a lot in the beginning of my career, right? Um, you go to school and you kind of meet like-minded people. Maybe you go to grad school, you meet like-minded people. ULI is specifically like-minded people for your career, if you're in this realm. And it's not just financiers. It's not just asset managers. It's everyone. It's everyone. It stands for Urban Land Institute. So for me, I joined their young leaders group when I was in my mid 20s, right? And I just started going to events. I think that's the toughest part for most people is just showing up, right? Even if you don't know anyone. And I would say that's where a lot of great connections were made for me because it forced me to talk to people or it forced me to be a part of conversations and meet people. And if you just keep going, like the first couple of times, it's going to be nerve wracking. It's going to be, what am I doing here? Oh man, I got to talk to that person. I don't even know what to say. What's my pitch? Who am I versus them? Like that imposter mentality or imposter syndrome is going to be so strong. But if you just are consistent, you just keep going to events, then you're going to start seeing familiar faces. You're going to start seeing people and they're going to become your friends. And then they're going to be able to share things with you, different opportunities or learnings, right? So ULI was incredible for my growth there. FIRE stands for Filipinos in Institutional Real Estate. So that is another one, but that's specifically for, hey, anyone can join, it's fine. But typically people that join are Filipinos and we're bonded by that. Hey, you have a similar background to me. You have a similar story to me. We kind of want to help each other and grow in this, right? So for me, it was great being able to, when I was in my later 20s, let's say, to be able to be exposed to that and be able to have mentors and gain mentors through both those channels, ULI and FIRE, right? And now I'm in the part of my career where now I'm looking to mentor others and help others, right? And that's why when your second part of your question, why is mentorship so important to me? It's so important because I've seen it have a direct positive impact on my life as a mentee, right? In my entire 20s, when I was a student, when I was a grad student, it was, hey, I have all of these questions. Can you help me, right? Or can you show me the way? Or how would you think about this? And people were so gracious to spend time with me and mentor me. So now it's kind of that paying it forward and coming full circle, right? Now that I've been afforded that luxury of people being so gracious to share their stories, share their learnings and teachings with me. Now I want to be able to give back and do the same for others.
That's amazing. That's so cool. I've met actually a couple of my mentors through ULI and these other orgs, so I'm really big on that. And Huber, what it would be one piece of advice that you could give anyone entering the commercial real estate world and to be successful in it?
I'd say avoid the title and avoid the title and the prestige game, right? Or the salary game where it's, oh, I'm just gonna go to a place to work because it's paying me more. I'm gonna go. That's fine. I mean, if that's for you, that's for you. That's fine. But my piece of advice would be go somewhere where you actually want to learn the material that you're hired to do, right? You're passionate about. Like if you are so into like, hey, how does land become a building and I want to know the entitlement play, then go work for someone that is expert in it in entitlement, and they're going to pay you to learn and work for them. Because if you're naturally curious about a topic and you're going to be able to work for someone and learn from them and get paid to do it, you're going to grow so much faster than someone that's simply there and checks out at 5 p.m., checks out at 6, they're in at 9 or 9:30, whatever, and they're just kind of there for a paycheck, right? Or they're there to put in their time until their next advancement title wise, right? Oh, I was an analyst, and if I spend half a more year, one more year, I'll become an associate, right? It's like I don't like looking at the world that way. I like looking at it as what can I come here to learn? What can I come here to learn and then do for myself? So that would be my one piece of advice: is choose a career, a job, right? And it's okay if it changes over time because your interests will change as you get more exposed to things. But go someplace because you're naturally curious about what they're doing and passionate about what they're doing.
That's awesome. That's really great advice. And Huber, for any young professional in college listening to this on our younger side, what would be just one piece of advice that you could give to them when it comes to navigating their career or like life choices, just like anything that you could give to them?
On top of, so I would say what I just gave still applies, right? Go places where you're naturally curious. I'd say the second thing is try to find a mentor wherever you go, and multiple mentors. Um, you will learn much faster. You'll be promoted much quicker, right? Those mentors are going to be with you regardless if you're at that job or anywhere. So I've been blessed to have so many great mentors throughout my career that have opened up doors for me or given me opportunities, right? I would say seek out mentorship and also try to make it a two-way street instead of, hey, help me. What can you do for me? I need this. I need that, right? What can you do to help your mentor also? Right? Sometimes it's just being there when they need like even something small, right? Whatever you can do in your capacity. It should be a relationship that goes both ways where they're helping you out with your career, you're helping them out with what tasks or something that they could use your help on, right? But I'd say the second piece of advice that I would give is try to find mentors along the way.
Awesome. That wraps it up, Huber. And where can people learn more about Credible CRE and just your work that you've done?
But yeah, absolutely. There's two ways. I'd say number one is the website, crediblecre.com. And then two is my LinkedIn. So my name is pretty unique, Huber Bongolan. I don't think there's anyone else out there with it. So if you just type in my name to LinkedIn, you'll absolutely find me. And feel free to connect with me there to follow along. But I'd say the website is one, and then LinkedIn is the other. And to your audience, always happy to connect. Feel free to shoot me an email. They're right there on the site and on LinkedIn. So shoot me an email, and happy to connect with you.
Sounds good. Thank you, Huber, so much for coming on the podcast. It has been a pleasure speaking with you.
Just likewise. Well
Awesome.
done.
Thank you.